Welcome to our subscriber webinar, FT Live Unhedged, the Trump effect on markets. Welcome listeners and FT subscribers. I'm joined by my colleagues in New York, Aidan Reiter, in Washington, D.C., Claire Jones, in London, Katie Martin, and in Oslo, Robin Wigglesworth. Welcome, team.
Hi, Robert.
Hi. Someone just started a weed whacker outside my window, but let me start with a question for you, Katie. The big news, of course, today is that Trump has backed off on tariffs, and that Powell and that Scott Bessent has backed off on China tariffs. Katie, is the Trump put or the Bessent put in place?
Yeah, I mean, I wasn't really expecting to come along here today and consider this to be a serious possibility, but it does look like there is a point at which the Trump administration blinks, both on tariffs and on Fed leadership. So these are the two themes that have been really consequential for markets so far in 2025. The tariffs have obviously pulled down US stocks. They pulled down US stocks much more heavily than they have stocks in the rest of the world. But the latest injection of confusion and anxiety really among investors has been around the leadership of the Federal Reserve. We had Donald Trump at the back end of last week making noises that certainly suggested that he didn't want Jay Powell to carry on as chair of the Fed for not necessarily for the length of his term, but just a much more kind of interventionist stance towards the Federal Reserve from the executive branch. And this has really spooked investors. It's made people worry about the safety of US government bonds and of the dollar. But what we saw in the past 24 hours or so is that it looks like this did reach the pain threshold for the administration. So we had the Treasury Secretary talking about progress towards some sort of deal with China and other big trading partners. And we have Trump more recently saying, oh, you know, I never suggested that I didn't want Powell to be in the job at the Fed. So there's just a huge amount of back and forth. But the overriding message is, I think, that when markets really cry out in pain, and particularly when it's the dollar and treasuries that cry out in pain, they do listen.
Markets are howling this morning. Futures are up several percent. And I guess the question becomes, is it safe to get back in the water now? Have we firmly established that when things are severe, Trump will back off?
For me, no. I think, you know, we are going to have a lot of short-term volatility. But I know from recording the podcast with you that you and I disagree somewhat on this point. But I feel like once you remove investors' ability to trust the administration, it's very, very difficult to get that back. So I think there is still going to be a risk premium sitting on US assets, whether that is bonds or the currency or stocks, for a really long time from here. I don't see how you can get back to the way the world was before Trump started his second term.
Okay, great. Let me turn to you, Claire. After these incredible turnabouts and caves and U-turns from the Trump administration, do we have anything recognizable as a economic policy that investors can count on and plan with? Or is it just we read the headlines on a given morning and hope for the best?
Look, I think what we do know is what economic policies Trump and his administration to some degree like and dislike. We know he likes low interest rates. We know they like low taxes. We know they like little regulation and lower government spending. And we know they like high tariffs. Does that mean to rest easy? I'm not sure it does. And the reason for that is just the nature in which they announce these things and the to and fro and that we have. So even though we have a sense of what they like and dislike, the timing and how they handle the kind of nitty gritty of policy making, and how sensitive they are to what happens in markets are all things that I don't think we have perfect answers for that we would with prior administrations. I think the big uncertainty and where there's a real lack of clarity is on the dollar policy. You've got some people in the administration, such as Scott Bessent, who seem to be, pro a strong dollar, but then there's messages from other people in the administration that they prefer a weak US currency. So there's not much clarity whatsoever at all about what this administration wants. Also on tariffs, clearly we know Trump likes high tariffs, but in terms of who he's listening to on that within his administration, that seems to differ a lot, whether or not he's listening to a hardliner like Peter Navarro or someone that markets and other governments feel like they can work with, such as Scott Bessent, really seems to change day by day.
Robin, any thoughts?
I mean, a million. It's been a crazy few weeks or few months, really. I think it's still wildly premature to say that sort of the safe haven status of U.S. Treasuries or the U.S. assets has ended. It's too baked in the cake, and the metaphor I always use is kind of it's like trying to extract sugar from an already baked cake. It's there, it's embedded in the entire global financial system. But I think it's fair to say it's been compromised mildly by what people see as fairly erratic policy making. I mean, you have literally the president of the United States early on, just before the Super Bowl, he was talking about how maybe some treasuries were illegitimate, that maybe they didn't have as much debt as they thought, raising the spectrum of selective default. And markets, very blithely kind of just ignored what he said because they saw it's just Trump. But I think it's getting to the point where you can't ignore it. So you have to price it in, but maybe you just price in a little bit, a slight sort of risk premium that wasn't there before. Maybe what in the UK we used to call a moron risk premium that we saw the UK got baked in after Liz Truss's disastrous budget. Maybe we're seeing that in the US. And, I think treasuries would be lower today and the dollar stronger if we didn't have that premium now. But let's face it, US Treasury yields are still very low. There's still a lot of them out there, and people still treat them as very safe assets. And the cliche that everybody kind of trots out for a reason is that it's the least dirty shirt in the closet. I always say there aren't many other shirts. Who else could be the global reserve currency, the global reserve asset other than treasuries? There are no viable contenders. So Trump can shake things up a lot and make people scared, but I just don't think he's going to be able to change that.
What makes me think that we may not be through with the turbulence is you mentioned that treasury yields are not that high. Stocks are not cheap. To read the headlines, you would think we've had a major correction in stock prices. We really haven't. Volatility is high, but we're only single-digit percentage down from the low after today's gains. From the high. So I still feel pretty spooked at the moment. Aidan, I wanted to talk to you a little bit about China. One area we haven't seen any Trump backtracking is on the China tariffs. How can investors kind of size the impact, given what we know so far, on whether it's corporate profits or any other measure of risk and return from these kind of swingingly high duties on China?
Yeah, this was one of the really interesting things in the wake of Trump's 90-day pause, right? The market breathed a sigh of relief when he enacted that pause, but he ratcheted things up on China. But given that so much of our trade is from China, and given that so much specifically of our intermediate goods come from China, right? I believe the number is 37% of goods from China are intermediate goods. So they go into manufacturing processes in the United States. The effective tariff rate now on China, or at least before the electronics exclusion, was higher than the effective tariff rate was when we had sweeping tariffs across the board. The reality is, our trade profile with China is so vast that these high tariffs on China enact more pain than just having lower sweeping tariffs around the world. So it is really large, and investors seem to have become attuned to that. As we think about what the next steps are, it's really hard to say what's going to happen. China's clearly not backed down. They've matched Trump's tariffs for the most part. They've enacted other sweeping bans on the export of rare earth materials, which we actually desperately need from China. They're essentially the only big exporter of the products. So it's hard to say what will happen there. There is pressure now. I've already spoken with some businesses that are having trouble navigating this constant regime and navigating their intense reliance on China and the countries in China's periphery. As in terms of what goes after this, I also don't think we can say, right? While Scott Bessent said he thinks a trade deal will happen with China, we don't know if Scott Bessent has Trump's ear on trade policy. If you read Peter Navarro's writings, Peter Navarro wrote this long treatise on what he thinks trade should be in Project 2025, which is a conservative, policy planning project. And he said very, very explicitly that any negotiations with China would be fruitless and against the administration's goals. So while I think there might be some backing off, given the market is relatively unhappy with what happens in China, and given there might be a real price shock from tariffs on intermediate Chinese goods, it's unclear whether the Trump administration is at all interested in actually negotiating. So I think we're going to have to see what the gossip is out of the White House in the coming days, in the coming weeks, to see if there really will be a negotiation with China, or if we're looking down higher tariffs for longer. The one thing that I heard that is more optimistic is at around 120% tariffs on China already, it's not like there's going to be much more marginal impact from raising those higher on the US economy. I'm not sure that's totally true, but I've heard people suggest that there's already going to be a huge inflationary and earnings impact of tariffs on China. It's not like we can get much more, or at least not like the market can really consider much more if they were to go higher.
Yeah, George Magnus, who's a China expert and a UBS guy, said at these levels, it's not Chinese trade tariffs, it's a Chinese trade embargo if the two countries go through at this level. The goal is not to, raise revenue or to slow trade or rebalance trade. At 150%, you're talking about really an embargo. Claire, I know you wanted to get in there.
Yeah, just on Scott Bessent, I think Aidan's right that we don't know, to what degree he's going to have the presidency going forward. But I'd say something that does seem to have reassured people here in Washington over recent weeks is that Bessent does seem to be in the ascendancy. There was the sense that he was the key voice behind the decision to have the 90-day pause. And it now seems that he's going to be the one leading some of these trade negotiations. I think with Trump, we really don't know if that's going to last. But at least in recent weeks, it seems like the US Treasury Secretary is carving out a greater role for himself. And I think that can provide some reassurance, limited degree of reassurance for people.
Yes, but there was that Wall Street Journal piece where they convinced him of the 90-day pause, but it was only because Peter Navarro was just not in the room at the time.
Yes, he was in a meeting somewhere else, and the Treasury Secretary was able to get into the White House. If we were to believe our rivals at the Wall Street Journal, that you have to wait until one official is elsewhere or is having a sandwich someplace in order to make policy. I never know what to make of these stories, but they are a bit unsettling. There's no question about it. I want to get to some questions from readers, and we have one from Anse Carols, and she asked, what will be the longer-term effect from attacking democracy on the financial markets? I think this is a relevant question because so many of Trump's most prominent policies are not directly about finance or even the economy, but they make people wonder about kind of the rules of the road. So whether it's deporting people or attacking law firms or whatever, does this kind of stuff matter to markets? Robin, do you have thoughts on that?
The short answer, it doesn't in isolation. Markets have always throughout history and will continue to be willing to lend to autocrats and despots or sort of more, intermediate types of regimes. China can borrow very cheaply, even though clearly the rule of law is not there what it is elsewhere. I just don't think it matters. It matters a little bit on the edges. I think it's more what it signals in norms being shattered. Generally norms matter right? We countries like China or Turkey or Saudi Arabia that might not be exactly the sort of the regimes that kind of we're used to in the West. We're still happy to lend to them because there's an expectation that they will continue to service their debts. They won't willy-nilly seize our ownership of shares in their companies. But if you start to attacking the rule of law, attacking democracy, then you maybe start questioning these other things. So I don't think it is irrelevant, but I think it's something that markets can adjust to. What they can't adjust to is this complete chaos of tariffs on, tariffs off. It's just, I want the Fed chair fired one day. No, actually, I never wanted him fired. I mean, it's to use Katie's favorite expression, it's like putting excrement back into a donkey. We can't do it. And I think that matters more to markets.
I'm going to disagree somewhat with Robin here. This idea that this stuff, rule of law and robust policy making doesn't matter for markets. The big difference between the US and, for example, Turkey or China is that the US makes up 70% of global stock indices globally, and or 60%, depending on which ones you look at. So the world is already massively overweight the US relative to the size of the US economy globally. It's just not comparable to the same situation with Turkey or Saudi or China. So I think the really important lens to look at this whole question through is, one of the questions we've been talking about recently is it time to sell America? For investors that I speak to, that's not really the question. The question is, do I really need to buy more America? So all asset managers have money coming in every month from my bank account and yours for for pensions or savings or whatever it is. They now have a decision to make, which is, do I pour more of that into a regime that appears to be spiraling out of control, or do I look for better alternatives elsewhere? And the other issue, I think, is that I see something of a difference in tone among investors that I speak to, depending on whether they're in the US or whether they're in Europe or Asia. So in the US, there's this idea that, yes, we're having a very sticky moment. Yes, policymaking is all over the place, but don't worry, things will still come back. It will all get back to normal. When I speak to asset managers in Europe, they're very different. I can't overstate the degree to which European asset managers were brutally offended by what JD Vance was saying at the security conference in Munich in, I think it was February. This schism between the US and Europe politically, and this breakdown of the post-war liberal order has affected European asset managers really quite profoundly. And no, they're not going to sell all of their US assets tomorrow, but I just don't see them accumulating them in quite the same manner as they were before. So to me, that rule of law stuff, even though it's a bit sort of squidgy and amorphous and a bit sort of, sounds a bit detached from markets, I think is really important.
Two readers, or rather viewers, have asked very similar questions. Norpel Wilberforce and Axel Rinborg both ask whether, as a response to Treasuries and other aggressive actions by the United States, foreign holders of Treasuries might express their displeasure through that market. It seems that the Treasury market in particular, has the Treasury Secretary's attention. The market does seem to respond. Do major foreign holders start to enforce their own demands using Treasuries?
Yeah, I think this is the big worry. And we saw this really big panic right after the tariffs went into effect. There was a somewhat weak 3-year, auction on 3-year Treasuries. That had everybody spooked. But since then, there's actually been decent foreign appetite for Treasuries, right? So people are still holding US debt. They're buying more US debt. Partially, maybe that's inertia, right? This system is based off of, you haven't really pivoted your portfolio away from it. That being said, on foreign investors, some of the data is kind of hard to parse, right? China is the second largest holder of US Treasuries. You can't really track them so easily. Some of their account is in Luxembourg. The Chinese government is not so transparent about what their buying is. We just finally got some data out of Japan, and there was a pullback on US Treasuries from Japanese investors and the Japanese government. That being said, it was not panic level pullback, right? It was in line with other market panics, concerns, but it wasn't catastrophic for the US government. So I think the point there is governments might start expressing that they do not want to hold US assets in the future. Maybe it becomes part of their negotiations with the United States saying, well, if you're going to hit me with tariffs, I might back up on my holdings. But you have to keep in mind that A, we haven't seen that quite yet. And B, that would also potentially impact those governments, right? For example, China holds a lot of US Treasuries. If they stop buying US Treasuries, the market stops buying US Treasuries, the price plummets, and then that hurts their own financial position. And especially with China, where they have their own domestic economic woes they have to deal with, they would not want to see a huge part of their portfolio lose a massive amount of value. So the US has some benefit here that nobody really wants to see all their money evaporate.
Several of our listeners are asking about alternatives. Kevin Forbes asked about gold. What if at the margin, as Katie emphasizes, the kind of institutional money is looking for alternatives? What alternatives are there? Again, nothing is going to replace the Treasury market, but on a small scale, at the edge, how do people diversify their exposure here?
Well, I mean,
Robin, do you have thoughts on that? Or Katie, go ahead.
I think we're already seeing that happen, right? So since this, since the tariff shock hit markets on April the 2nd, the degree to which US government bonds has risen in price has been really conspicuously small. So we still have US 10-year Treasury yields at about 4.3%. So they have come down from the peak, which means that there is some demand for US government bonds. But you would imagine that in the sort of fraught situation that markets find themselves in now, you can argue they sort of should be quite a fair bit lower. Now, why aren't they lower? One reason for that could be that people are worried about inflation over the short and long term. Fine. But there is very clearly quite a strong amount of demand out there for other types of safe government bonds. So, for example, German bond yields have fallen really quite heavily from the peak that they saw at the start of this year. So there's lots of demand out there for bonds. Similarly, there are some parts of the Swiss government bond curve. There are, some of the Swiss curve is trading now with negative yields. Negative yields are back. So there is so much demand for Swiss government bonds that they are guaranteed to give any new buyers a nominal loss if they hold them to maturity. And so that is telling you that the market is looking for safety, but it doesn't want the US to provide that. So that's why you've got the gold price shooting higher. That's why you've got a strong bid for other types of government bonds. Now, granted, the European government bond market is not ready for prime time yet. It's not ready to assume that role that Treasuries have played in the global financial system for the past few decades. There is no individual national bond market within Europe that's simultaneously big and liquid and safe enough to provide all of those characteristics. But it's really not difficult to imagine that the EU and the ECB could work together to pull together some sort of arrangement for Europe to borrow much more heavily on a joint basis. And all of a sudden, you have something that really starts to, I would stress, but starts to challenge the Treasuries market for that role as the global safety valve. So we're not there yet, but we are in a world where the US is generating demand for alternatives all by itself. And I think the market will provide that.
Yeah, I mean, I can shoot in. I'm more skeptical on common Eurozone issuance just because I've been covering that for almost a decade. And it's been flirted with for a very long time. And the Northern European countries are dead set against it. There are sort of half-assed versions, like kind of bonds issued by the European Commission and the various Eurozone bailout facilities that kind of look a little bit like it, but they don't walk or quack like proper common Eurobonds. But I completely agree with Katie's point that, where there is a demand for something, financial markets are pretty good at coming up with it. And as it happens, Germany, has dropped its sort of its rather strict adherence to the budget deficits. I mean, Claire, who used to be our Frankfurt bureau chief, can talk a little about that as well. But there is a change in Germany and in Europe, and So I think there is more money that's going to go into the French government bond market, the German government bond market, definitely a few others, the Swiss, the Japanese, the Australians, the Kiwis. The problem is, like, if we're really talking about replacing treasuries, like as a sort of reserve asset, there is nothing that compares. I mean, the trading volumes in US government debt is on average $1 trillion a day. $1 trillion. There is nothing else. The German and French markets are quite big in size, but they just don't trade. All those bonds are just locked away in pension accounts, insurance companies. It doesn't compare to the treasury market. So I think we will see more money going to these alternative assets, maybe a bit of gold. The gold, if you're a central bank or frankly like an asset manager, is not great. You want something that's easily liquid and tradable. And gold, if you're selling, well, you might be selling at a time when everybody else is selling. It's going to be very difficult. So I just, gold is a natural thing to buy, but I think, keep an eye on the New Zealand bond market. There we might see some growth. On
the point of alternative assets, it's far from liquid, but there was a great piece by our new correspondent in Zurich, Mercedes Ruhl, talking about Americans' interest in Swiss chalets as well. Just moving from the markets to the macro, I think Robin's totally right. We're moving into an era where Germany and quite a few of the major European economies are going to be issuing more debt. We've seen the announcement from Friedrich Merz about the creation of a defense bazooka. We've seen the relaxation of the debt brake. That's not just going to mean more issuance on a federal level. They've also relaxed the constraints on the lender, which are the German states, which are also powerful and do a lot of their own borrowing. So there's a lot of potential for those markets to expand, albeit at a far smaller scale than the market for treasuries.
Yeah, I think it's worth bearing in mind that there has been something of a move away, at least from the dollar, by central banks around the world for almost 60 years, right? The dollar's percentage of FX reserves ticks down about 0.5% every year for the past 60 years. But crucially, what has replaced it is not euros or the renminbi, despite many people's efforts. It's just a broad diversification to other currencies like Australian dollar, Singaporean dollar, et cetera. So there might not be one benefactor, although I agree with Claire that the fact that Europe is releasing some of its own debt could mean that it can start to fill some of that void.
Well, I have a question from a viewer, Joris Stork, who asks about recession, and if tariffs cause a recession, what kind of recession be? A proper financial recession, by which I assume he means one caused by a market shock, a real recession, meaning real economic activity, or a policy recession. So if tariff policy is not softened further, what are the chances of recession, and what might that recession look like? I'll kick that to Claire first, but anybody's thoughts are welcome.
Sure. I think that certainly is a mountain risk of recession if there are aggressive tariffs. The channels, I guess there are a few channels. One, they just create a lot of uncertainty, so you don't get investment. And under times of uncertainty, consumers tend to buy a lot less. What we've seen initially is actually like the opposite of consumers hoarding. We've actually seen some evidence of consumers going out and front-loading purchases. So if you look at the auto sales data, consumption's holding up well at the moment, but there's big questions as to whether that'll last. I also think another channel by which we might see a recession is through the wealth effect. One of the big reasons why the US has outperformed other advanced economies over recent years is because US consumers have been so active. If they start to see their 401ks doing badly, there is quite a sharp wealth effect here compared with other countries. So that would weigh on consumption too. So without that lift, and then also having other policies such as, federal spending being cut, and that, raising the prospect of people being without jobs or worried about losing their jobs, there's another channel there too. Whether or not it'll be a big recession, let's wait and see.
My response would be that you're exactly right. Consumers are very sensitive. And you also have to remember the context, which is that we had a massive burst in consumption, the post-pandemic boom, and we're kind of coming out of that anyway. So, for example, I was looking at industrial companies yesterday. They were already after the post-pandemic boom, they had a post-pandemic slump. And now those companies, they're still dealing with the fluctuations in inventories. And now you're starting to hear reports that capital expenditure plans are being pared back. And for me, it's that capital expenditure channel that will prove to be the most important. The companies face uncertainty. They change their capital expenditure plans. And it's those big purchases, either by companies or households. Are companies buying new machinery? Are households buying new mattresses or new cars? That is the marginal economic activity that defines the difference between a boom and a slump. And for me, the economic worry is that those purchases really start to slow down. And indeed, I think we're already seeing that. And if this kind of tomfoolery in the White House continues, I would expect that pattern of large capex and large consumer durable items to continue, to say nothing of housing and so forth.
I mean, the other danger that I think we've got here is that, the usual response that we'd see to the rising risk of recession of basically cuts by the Federal Reserve. It's not so clear they'll do that. I mean, they're in wait and see mode. They're very concerned about the impact that tariffs are going to have on prices. They want to be pretty sure we're not going to see inflation hit the sort of levels we saw and persist in the way that we saw after COVID before they're going to be willing to budge. And I mean, the other thing is if we've got the amount of uncertainty we have at the moment and that lingers, what's a 25 basis point or even a 50 basis point cut really going to do? I mean, is it going to move that marginal activity, like you say? Are you going to invest in the new plant or buy the new mattress if, you just don't know what's going to come from the Trump administration next?
I'm going to ask a question from Chris Durbin, a viewer, which I'm asking because I want to see Katie and Robin's reaction. Crypto, can the panel give us some insights on what is going on there and what to expect? I'm afraid, Chris, you're sitting here with five pretty big crypto skeptics. But anybody wants to throw a thought in there is most welcome.
Look, everything to do with the US and frankly global economy and everything to do with markets at the moment is very much at the whim of one man. And that has even more so the case when it comes to crypto. So we have seen this is a much more crypto-friendly administration. And we've seen moves towards making some sort of strategic reserve of cryptocurrencies. Strategic for what, I don't know, but that's probably not an argument for me. But we've also seen that, crypto is an incredibly speculative asset. And so, when stock markets have been pulled lower by all of this uncertainty and chaos, exactly the same thing has happened to the price of crypto. So where it will go from here depends on, look, there could be an executive order tomorrow saying, I hereby order the Treasury, whatever it is to buy every Bitcoin they can find, in which case, sure, it goes to $200,000 a piece, or that could just not happen and the price could continue to bleed out over the next few months. Anyone who tells you with any degree of certainty that they know what's going to happen to the price of Bitcoin or any other crypto over the next few months and years is lying to you. There is no way to be certain about this because it all depends on that man in the White House.
I think it's interesting, though, that so many people in crypto that I've spoken with are so convinced that it is going to be, the non-government asset. It's the thing that when there's financial panic, that's what governments turn to. As we've talked about a couple times already, right? We're in a moment where people might be diversifying away from the United States. Foreign central banks, non-U.S. central banks, are potentially looking for another route. Crypto is down. Bitcoin is down. If anything, that should put all this nonsense about crypto will become the new reserve asset of the world to bed, or at least partially to bed, right? It's not getting
gold is up.
Gold
Right?
is up. If anything,
physical gold worked, digital gold did not work. I mean, I really think that's what we've seen.
Yeah, crypto for grandfathers went up.
Boomer crypto. Yeah.
There is a question here that I think is interesting because it's relevant. Not only it's relevant to private equity, which is of course very important here. Jack Paul asks, what are your views on the outlook for M&A and capital markets? Will the uncertainty keep markets frozen, or will they open up now that we have a pause on some of the tariffs? I think, it's been very striking to see the stocks of the publicly traded asset managers who sort of started out as private equity companies, the Apollos and the Blackstones and so forth. Those stocks have taken a hammering. And I think part of the reason for that is that the M&A, the IPO and M&A markets are both wobbly. So they have they'll have a much more difficult time sourcing and disposing of investments. What do you guys think? Is it an M&A winter now?
Well, I was talking to a senior private equity executive the other day and said, all the big kind of private equity names that are publicly listed, they're all down hard. The IPO market, so the market for listing new companies onto the stock market, is asleep because the market is too volatile. There's a lot less of, the animal spirits are dead. So people are not necessarily looking for sort of spicy investments in this environment. This is all bad for private equity, right? And absolutely true to form. He said, no, you got that all wrong. This is why it's all great for private equity. People are looking for uncorrelated assets. People don't want all of their investments marked to market every minute because it's too brutal a picture. They would rather have long-term investment locked up in private equity vehicles. And look, who am I to say that he's wrong? He's on the coalface, he does this stuff for a living. But it strikes me that, yes, unless you can unfreeze the equity markets so that it is possible to list portfolio companies on stock markets around the world again pretty soon, then I think the market is right to be marking lower the shares in these private equity companies. I think it is a very difficult environment for them. And then you've got the added risk that, where you do have lots of activity in private markets, whether that's private equity or private credit, a lot of this goes to companies that are going to be hammered in the US by the impact of these tariffs. So all those small businesses out in the US that are paying, a 145-ish% levy on their imports that they need to be functioning as going concerns, this is going to really hurt small business in America to a much greater extent than it will in the rest of the world. So I struggle to replicate that optimism that this private equity executive was talking to me about.
They're also, of course, private markets are also, of course, struggling with the fact that they've been so successful. The inflows to private equity and private credit have been so immense that it's like a struggle to put all the dry powder to work. The competition for deals is incredibly high. It's almost like they're suffering a cyclical hangover that, whatever Trump was doing would be a challenge for that industry. I have another question. Oh, go ahead, Aidan.
I was going to say, something interesting that's coming out of this is, and if anybody is an unhedged reader, this will be in tomorrow's newsletter. There's been a new flurry of SPACs. We kind of thought SPACs were dead since 2021, 2022.
We hoped SPACs were dead.
We hoped. Turns out, it's not. We're not anywhere near those levels, but there has been this increased issuance of SPACs. And when I spoke with someone who follows this closely,
you want to just pause and tell our listeners who are lucky enough not to know what a SPAC is? Do you want to explain what that is?
Yeah, it's a special purpose acquisition. What is the C for, actually? Special purpose acquisition.
Company.
Company. Essentially, you take something public on the market, either to take to purchase some other company. So essentially, it's a shell that is listed that raises the capital to do something else with, right? Whether you're going to buy a private company and make it public, or you're going to take a public company private, right? It's just this empty vessel.
So give us your money and we'll do something with it later. And we promise it will be good.
So somebody I spoke with who covers the space very closely said that part of the reason we've seen a recent flurry of SPACs is A, people thought there was going to be a more lax regulatory environment in the Trump administration. That hasn't totally panned out yet. It still could. And B, private capital is already constrained. So this is one route to raise capital in an otherwise hard to raise private market.
We also have questions here, one from Marco Manini about the impact on credit markets. And Robin, you might have thoughts on this. I've been really struck by the fact that credit spreads, the premium private companies have to pay over sovereign debt. I mean, it's widened, but it hasn't blown out. The corporate credit boom seems impossible to stop. Do you think eventually the turbulence and worry we see in the equity market kind of arrives in credit, Robin?
It has to a slight extent, but I agree that maybe you might have expected even a greater sort of reaction there. In the credit markets, we care because, frankly, they're slightly less of manic depressant than the stock market. The stock market is famously predicts booms and recessions on a 5-minute window. And credit, tends to sort of, we see that's a better, more accurate harbinger of economic distress. And it seems to be saying that, there's clearly an economic slowdown now, but it's not to the point that it's going to threaten certainly big, strong companies. And even the junkier stuff, we've seen a widening of spreads or a sell-off in the riskier sort of reaches of the junk bond market. But nothing like what you saw for 08 or March 2020. I do think that's both rational, that we're still talking about lots of companies are going to be making a lot less money, and some companies are going to be struggling in this new environment. But, we're talking about a cyclical recession maybe, and they don't tend to last super long, and they're not a big depression. So I think that's fine. But there are also maybe technical reasons that are maybe making the credit market seem healthier than they really are. And people forget that these bonds, they pay off coupons. They throw off money all the time. So even if you and I never put a single dollar into a bond fund, that bond fund, as long as all the companies aren't going bust, is still generating hundreds of billions of dollars worth as a market as a whole that's going into corporate credit just from companies making the interest payments. And if you're a bond fund manager, you have to put that into the market. And certainly in the high yield market, you talk about private credit, we've seen a lot of the riskier borrowers actually go into private credit because that market was booming so much. They could borrow so cheaply. So the high yield market, the kind of junk bond market that you normally see these that's where the warning lights would be going off, is essentially stagnated for a long time now because there's so much money getting reinvested constantly. From billions of dollars of coupons. And I think that is maybe making the credit market seem healthier than what they really are. But we'll find out if and when we have a recession, how bad it is, whether they're kind of smoking as much opium as the stock market is, or whether they were rightly saying this is a bad thing, but not an Armageddon quite yet.
I have several questions here from listeners about the future of the dollar. We've seen a pretty big move there. And of course, for global investors, the movements in the dollar have a huge impact on any asset they're buying in the United States, whether it's treasuries or stocks or something else. The future of currencies is notoriously hard to predict. But are there any kind of roadmaps that we can use to think about the future of the dollar here? Claire, do you have thoughts?
I think it's very tough. I mean, as you say, there's only a few historical instances of us really seeing major changes in global reserve currencies. So I think it's very tough to stay, especially at this stage. As someone from a central bank's background, just keeping an eye on what the central bank reserve managers are doing and thinking, to me, is quite important, just because they're so conservative in terms of for the most part. I mean, there's a few exceptions like the Czech National Bank who buys Bitcoin and so on, but they're quite conservative. So I think if we see them shift their attitudes, then it is quite an important sign for me. But but I think it's far too early to say.
I mean, I think, making long-term predictions or medium-term predictions about currencies is totally a fool's errand. It's very easy to look very stupid very quickly, but you can still make a few observations about how the market has performed in the year so far that are actually really important. One is this absolutely steadfast relationship between market risk appetite and the dollar has totally broken down. And this is balking risk models in banks and funds and hedging companies all over the world, because everyone knows when the market gets nervous for whatever reason that the dollar goes up. And that has stopped happening. You can argue about why that has stopped happening, but it has very clearly stopped happening. And that's a really big shift in regime. Whether it will last or not, we don't know, but it's really spooking people.
But at the very least, we know that it can happen now.
We know
right?
that
even if the relationship returns to normality, we know it doesn't have to stay there now.
And it's also just, I think, important to just stand back and look at the scale of what has happened so far this year. The dollar, the DXY dollar index is down by 9% this year. That's a really significant move. Now, that particular dollar index is particularly heavily weighted towards the euro, but you can see a pull lower in the dollar absolutely across the board. And that does some very weird things to people's portfolios. So US stocks, for example, are down 10% year to date. They're obviously in dollars anyway. The DAX index, for example, in Germany, that's up 10% in euros, but 20% in dollars. And the FTSE 100 is up 3% in sterling, but up 10% in dollars. So all of a sudden, the equation for different types of investors in different parts of the world about where they put their money to work changes really quite a lot. So you don't necessarily need to have a strong view about whether this is the beginning of the end of the dollar's dominant reserve currency status. It's enough to look at the size of what has already happened this year to say that this has been a really big moment for the way that currency markets operate.
I mean, what you say there really resonates with me. I'm old enough now that I've been an investor for a couple of decades, personally. And for most of those 2 decades, I've been sitting there regretting every bit of global diversification that I've ever had. Like a good boy who went to finance school, I owned European funds, Japanese funds, world funds, emerging market funds, and they've all sucked. Almost the entirety of my investing career. I should have put it all in the S&P 500 from the very beginning and just left it there. Small caps stunk too, everything. But for the first time, in 15 or 20 years, these things are working. And I get, again, it's hard to say if it's a regime change, but boy, is it different from, even long-term history up until this point.
I mean, I think partially it's other things are working. Partially it's the U.S. It's just the U.S. market has just done so badly in the past couple of weeks. So emerging market, the MSCI EM, index, the kind of gold standard emerging market index, has outperformed the S&P 500. It's still low, it's still down, but it's just doing better than the United States. So while I think that, yes, there could be some stories of real, outperformance like the DAX, a lot of it's just down to the U.S. kind of being overpriced and there being this big risk off in the U.S. for the past couple of weeks. And it's unclear if that will remain.
Yeah. We have a couple of questions here. Readers are clearly interested in the issue of whether all this political influence on markets has opened the window for massive insider trading possibilities. I don't know what to make of that question, except to say, I mean, we've had a couple of stories, for example, about IPOs and so forth, that there seems to have been some, there seems to have been some, not IPOs, but announcements where there seems to have been some unusual trading before the announcements came out. I guess it's a question of reliability of capital markets in an environment where political news is particularly important. But are we to take this stuff seriously, these accusations of insider trading by the administration or people near to the administration?
I will throw
I
myself.
See everybody's dying to answer that question.
just gonna run and get a lawyer before I answer that question. No, I mean, I think I don't know, frankly, whether there is any trading that's happened that's untoward. You can definitely see some quite unusual trading patterns, like some purchases of US stock derivatives that come ahead of some of the big tariff rollback announcements. But sometimes people get lucky. I'm not in a position to say for sure what really has happened there. But what I am in a position to say is that it's not great when that is a really widespread suspicion in markets and in in daily life.
That's
that
exactly
people
the point.
think that the trust in markets has eroded to the point where that's taken as a very serious possibility. That's actually quite an alarming sign for the health of the market. And there was another element that I think is important here is that the comments that came from Treasury Secretary Scott Bessent indicating some progress around tariff talks yesterday, that came from a closed door meeting to which media was not invited. And so you get to the point where some people know certain nuances around Treasury's thinking before other people. That's probably not helpful. You get bits that can get misreported because there weren't journalists in the room. That's probably not helpful. Again, it goes back to this really important issue, which is that the communication by the administration is just all over the place. So the strategy is all over the place. The communication is all over the place. And I think investors, broadly speaking, would be much happier if they just knew that all of that was on a level. But we've got to get over the idea that we can get back to the way the world was before Trump came back into office. This is just the world that investors are dealing with now, which is that there is chaos and suspicion where it wasn't necessarily there before.
I think that's exactly right. I mean, my immediate thought when I heard about the Bessent story yesterday was just, that's the sort of thing that could cost another kind of advanced economy finance minister their job. But it just kind of just passed as, oh, this is another day in Trump land, basically. And that says a lot.
And it's not necessarily insider trading, but, just at the very beginning of this administration, they released a Trump coin, which is just essentially something that the current president, if you buy this asset, it inflates the value of his portfolio because he owns so much of it. And that is already a huge erosion of norms, right? Essentially, that is a very easy way for people to, not saying anybody's bribing the president, but to directly make a payment that makes him richer. So just from the start of this administration, we've seen a lot of the norms around the Hatch Act and various other laws kind of slipping away. And as Katie said, the fact that we have to even have this conversation is concerning.
I want to come back to a topic that we have touched on glancingly, but I think is important enough that we would be remiss in not mentioning it, which is inflation. Mm-hmm. If we'd been having this conversation 6 months ago or a year ago, that would have been the whole topic, right? That would have been the whole discussion would have been wither inflation, how will the Fed manage it, and so forth. Aidan and I were looking at markets yesterday. It's pretty clear that long-term inflation expectations have come down. There's some short-term inflation expectations, but basically markets are not very concerned about inflation. Are we comfortable with that? Is the inflation genie back in the bottle?
I think it's a big question. The Fed certainly doesn't think it is necessarily. I mean, their messaging on this has been very clear. I mean, they think, in the short term, prices are going to rise. I think John Williams of the New York Fed says he expects to see inflation rise to 4% over the short term. I think Chris Waller of the Fed board here in Washington said something like 5%. I mean, the big question is whether or not the hit to demand from the tariffs could be so bad that inflation doesn't really endure. I think what's concerning the Fed so much is we've just seen the worst wave of inflation for a generation. It was also a wave that they really got wrong and said was transitory, and then it turned out it wasn't. I think the real fear there is that, firms are used to using previous price pressures as an excuse to make price rises. They want to do the same. They want to do that. And the risk is that they do the same this time around too.
Yeah, I mean, exactly as Claire describes it, this is a very, very difficult environment for economists and investors and policymakers to make any confident pronouncements about what's going to happen with inflation next. So for the US, the weighted average tariff rate is going to be something in the order of 25%. So this is a massive step higher in US costs, even with the rollback that we've had in the Liberation Day tariff announcements. Life is going to get more expensive for Americans. Now, what we don't know is, will that last? And what we also don't know is, will that be severe enough to tip the economy into recession, such that that becomes the more pressing concern rather than the inflationary element? And exactly as Claire was saying, that's why policymakers are very keen to say, I don't want to make any predictions here. We're very data dependent. We are very willing to act in either direction as we need to. But it's very difficult for them to plan ahead, just as it is for companies.
Aidan has made the excellent point in the newsletter more than once that I don't mean to steal your thunder here, Aidan, that it's not only the question of growth versus inflation, it's the sequence of the two, right? For central banks, do we get the inflation first or do we get the growth slowdown first is a really crucial question. And if we learn anything from the pandemic experience, it's that even if you understand the general direction things are going, the timing of these things is really close to impossible to predict. Everybody who was right about the timing of inflation on the way up was wrong about the timing of inflation on the way down. So it's you sympathize with the world's central bankers, is that they have two variables that are unclear, and it matters which comes first.
Yeah, and it's easy to imagine either scenario happening. Go ahead.
Sorry, and I think the fear that officials have is that, we're back to a world of stagflation, basically. I mean, they're being quite clear and saying, if you've got an effective tariff rate of 25%, it's going to highest level for more than a century. It's not going to just raise prices, it's going to lower growth as well. But the focus is, I think, on prioritizing inflation and just making sure what we've seen in those short-term inflation expectation surveys that we've seen shoot up doesn't start to be kind of like embedded and affect the longer run inflation expectations too.
I want to give a little bit more, following on that last question. There's been a lot of reader questions about gold. We talked about it a little bit before. It's now at an unbelievable $3,500. And is this still a viable safe haven? Has it become a momentum asset now? Is it a kind of FOMO asset now, or is it still a place where you can take shelter not only from inflation but kind of general fiscal and monetary hijinks?
I'm not picking up the sort of kind of hyperbole that I normally see when you do have these FOMO moments in gold. I think, yes, it's up 26% so far this year, and there's no way around it. That's a lot. But I don't get the impression that this is really a speculative frenzy at this stage. So it's not clear to me that it's tapped out.
Yeah, I feel the same way. And I don't think you're going to see, I was a long-time gold skeptic, but the last couple of years have been a real education and in how gold can act when uncertainty really takes over. And, that's kind of, I feel like is what we've learned, that it's not that gold is so much an inflation hedge. It's a hedge against uncertainty and fear, and in particular, uncertainty and fear about the kind of fiscal situation, even independent from immediate questions of inflation.
But is it though? I mean, there's been no shortage of fear and uncertainty and concern about fiscal situations over the past 10, 20, 30 years. I mean, frankly, ever since Nixon took the dollar off gold. And lo and behold, gold has just basically stunk out. The fact that I don't think we can base gold having a major role or even a minor role in portfolio on a few months of positive price appreciation. I mean, Trump coin did pretty well for a period as well, but I'm not going to put that in my pension account. So I still think we are maybe judging gold on an unfairly low bar here. it has gone up, but I think it's not necessarily the FOMO like Katie was talking about. It looks like we've lost her, unfortunately. But it's just, people want something that goes up. This has gone up, more money goes into it, and it goes up more because it's not very liquid assets. So,
Robin, my response to you on this point is, have fun staying poor.
Yeah. No, I'm having tons of fun staying poor.
But no, I hear your point, and I think it's the relevant one. We are now out of time. Viewers and subscribers, thanks so much for coming in and listening and sending along your questions. Claire, Katie, Aidan, Robin, this has been great. Thank you for joining us, and please register for next month's subscriber webinar on the 28th of May about the U.S.-China showdown. You can register for that at ft.com/US-China. Thanks very much. See you in a month.